Welcome to the deep dive. You, the learner, sent us I Will Teach You to Be Rich by Ramit Sethi. Our mission to pull out the real actionable wealth building strategies and cut through all that confusing finance noise.
Exactly. And Sefi's book, well, it's got this really direct, no-nonsense style, doesn't it? Often quite funny, too.
Yeah, it really focuses on the big levers like automation and thinking long term. It kind of pushes aside the obsession with tiny details.
Right. It skips the whole should I buy this latte debate pretty quickly.
So for you, the learner, we're going to highlight those key aha moments. We'll structure it so it's engaging, clear, and maybe, a little unexpected.
Sounds good. So where does he start?
Well, right at the beginning, he kind of tackles this obsession with financial minutia. He compares it to endless diet arguments, like should you eat this specific berry or that specific seed?
Yeah, and his point is that focusing on, say, saving $3 on lattes is, it's mostly a distraction.
The real engine for building wealth is simpler, right? It's basically spending less than you earn and investing the difference consistently.
That's the core. He uses this great analogy. You don't need to be a nutritionist to lose weight fundamentally. It's eat less, exercise more.
Or an automotive engineer to drive a car.
Exactly. And you don't need to be some Wall Street wizard to get rich.
Which, I think, for anyone listening, should feel like a relief. It takes the pressure off needing to know everything.
It really simplifies things. Focus on the big wins, not the tiny details.
Okay, so then he moves into something I think everyone feels sometimes, that inertia, getting stuck when it comes to money.
Oh, yeah. The mental roadblocks we build. I don't know enough. The paperwork seems overwhelming. What if I pick the wrong investment?
All those things that stop us from starting.
And his big message there is just start. Take one small step. Don't wait until you feel like an expert, because that day might never come. Momentum is key.
Just get the ball rolling.
Understand the barriers,
Yeah.
realize they're often self-imposed, and then just start putting your money in sensible places.
This kind of leads into his critique of traditional personal finance advice, doesn't it?
It does. He argues pretty forcefully that a lot of the old advice was maybe aimed at, our parents' generation or a specific demographic.
Focused on stuff like super complex tax optimization or cutting out every single small pleasure.
Right. Whereas younger people, or maybe just people starting now, they care more about different things. Like, where's my money actually going? How can I automate growth? How do I avoid getting ripped off by fees without needing a PhD in finance?
It's a different set of priorities.
Definitely. And that brings us to the fears, the worries people have.
Like losing money in the stock market. That's a big one.
Huge. And his counter is, first, think long term. The market goes up and down, but historically, the long-term trend is up.
Plus, he points out you're already losing money if it's just sitting in a low-interest savings account, right? Because of inflation.
Exactly. Inflation eats away at your purchasing power. And besides, there are different types of investments with different levels of risk. It's not all or nothing.
What about the excuse, I don't have enough money to invest?
He tackles that head on. He basically says, the book will show you how to find that money by looking at your current spending, streamlining it. Even small amounts saved consistently add up massively over time. Compound interest is powerful stuff.
He really pushes personal responsibility too, doesn't he? Comparing it again to the diet industry where there's often a lot of guilt and blaming external things.
Yeah, he's quite blunt about taking ownership. Just like with health, you need to grasp the basics of money management and actually do something.
Otherwise, you just get overwhelmed and end up financially unfit, I guess.
Very much.
Yeah.
So the core principles for building wealth, according to Sethi.
It seems to boil down to a few key things. Small steps, consistently.
Yep. Reducing choices so you don't get paralyzed.
Getting started is more important than perfect research.
Definitely. And letting your money serve your life goals, not the other way around. Money is a tool, not the ultimate prize.
And trusting the data, the historical evidence of investing, rather than reacting out of fear.
That's a big one. Letting data, not headlines, guide you.
Okay, I love this next analogy he uses. The sexy versus rich idea in investing.
Yes. This is great. He contrasts the excitement of day trading, picking hot stocks, trying to time the market. That's the sexy approach.
Which rarely works out long-term for most people.
Right. Versus the boring strategy. Automatically investing month after month in good, low-cost, diversified funds.
Yeah.
Buy and hold. That's the path to actually getting rich, even if it doesn't make for exciting dinner party conversation.
So do some homework up front, make a solid choice.
And then mostly leave it alone. He suggests maybe checking in, reevaluating every 6 months or even annually, but ignore the daily noise. Tune out the hype.
This fits perfectly with his idea of conscious spending. Can you unpack that a bit? It's not just budgeting, is it?
No, not traditional budgeting, which often feels restrictive. Conscious spending is about deciding what you love, what you truly value, and then spending extravagantly on those things, guilt-free.
And the flip side,
Cutting back mercilessly on the things you don't care much about. It's about deliberate allocation based on your priorities.
he uses his friend Jim as an example, right? The guy who got a raise but moved to a smaller apartment.
Yeah, because Jim didn't really care about having a huge place. What he loved was camping and biking. So he consciously cut his housing costs to free up more cash for his hobbies.
That makes so much sense. It's about trade-offs, but making them consciously.
Exactly. So for you, the learner, the question is, what do you love? Where can you cut back without feeling deprived so you have more money for the stuff that actually brings you joy?
All right, let's shift gears to credit cards. Often a source of stress for people.
Definitely. But Sethi challenges that simple credit cards are evil narrative.
He argues they can be a tool, but you need to understand them. Starting with your credit score and report. What's the essential difference again?
Okay, so the report is the detailed history, like your payment record, accounts, inquiries, all the data.
The raw facts.
Right. The score, usually a FICO score, is just a 3-digit number summarizing that report. It's a quick snapshot for lenders of how risky you might be.
And getting both isn't hard.
Nope. Annualcreditreport.com for the free annual report. The score might cost a little, but many banks or credit cards offer it free now, too. Worth checking.
So the dangers of credit cards are real high interest fees.
Oh, yeah. The APR, the annual percentage rate, can be brutal if you carry a balance. That's how they make a lot of money. Plus, late fees, over-limit fees, it adds up.
He actually argues that these fees can be a much bigger drain than, say, buying coffee.
Absolutely. So the goal isn't to avoid cards entirely, but to use them smartly, optimize them, beat the companies at their own game, kind of.
How do we do that? He
Yeah.
gives specific tactics, like asking for fee waivers.
Yeah, it sounds simple, but it often works. He tells a story about someone, Eric Henry, calling after missing a payment. Polite call, mentioned his good history, and boom, fee waived, some interest refunded.
It's gotta ask. What else?
Switch to no annual fee cards. Sethi's pretty adamant. Most people shouldn't pay an annual fee. Unless you spend a ton and the rewards genuinely outweigh the cost, stick to free cards.
And if you have a fee card?
Call and ask them to waive it. If they won't, ask to switch to a no-fee card with them if possible, so you don't have to close the account, which can sometimes ding your score.
Okay. Negotiating a lower APR, that seems important if you ever carry balance.
Crucial. Average APRs are way higher than average stock market returns. Paying 15, 20% or more is just throwing money away. Call them, tell them you're a good customer, mention competitor offers, and ask for a lower rate. The worst they can say is no.
Then there's keeping cards open for a long time. Seems counterintuitive if you're trying to be responsible.
But it helps your length of credit history, which is a factor in your score. So keep those old no-fee cards open. Maybe put a small recurring bill on them, like Netflix. Pay it off automatically just to keep them active.
And strategically increasing credit limits. How does that work?
It's about your credit utilization ratio. That's the amount you owe divided by your total available credit. Lenders like to see this low. Under 30% is often recommended.
Ah, so if you have a higher limit but keep your spending the same, your utilization goes down.
Exactly. Which can boost your score. You can usually request a limit increase online or with a quick call.
He also mentions keeping track of calls with banks and credit card companies.
Super important. Date, time, who you spoke to, what was agreed. It can save you headaches later if there's a dispute.
Okay, what about mistakes to avoid? Closing accounts is generally bad.
Yeah, usually. Because it lowers your total available credit, which can increase your utilization ratio if your debt stays the same. So unless the card has a fee you can't get waived, or you truly can't trust yourself with it, keep it open.
But think ahead if you're applying for a big loan, like a mortgage.
Right. You generally want your credit profile looking as good as possible before a major loan application, which usually means keeping accounts open and utilization low. Maybe hold off closing anything right before applying.
And the 0% balance transfer game, he's not a fan.
Not really. He sees it as potentially risky, easy to mess up the deadlines, and kind of a distraction from focusing on the fundamentals, the big wins, like saving and investing consistently.
Got it. And finally, retail store cards.
Steer clear, generally. High APRs, low limits, often pushed on people with weaker credit. The initial discount is rarely worth the potential cost.
Okay, that covers credit cards. What about debt in general? Student loans, credit card debt.
Yeah, he notes how common debt is, but questions if it should be considered normal, especially for things that aren't appreciating assets.
He focuses on student loans and credit cards as the big ones for younger adults.
Right. For student loans, he acknowledges they're tough to get rid of. But even small extra repayments make a huge difference over time by reducing the principal faster.
And he really encourages calling the lender.
Absolutely. Ask about options. Can extra payments go directly to principal? What repayment plans are available? Don't just accept the default payment schedule without exploring.
And if credit cards have already gone bad, meaning you're carrying debt.
Priority number 1, pay the full balance every month going forward. Stop the bleeding.
He uses that dumb Dan versus smart Sally example, right?
Yeah, showing how paying only the minimum costs a fortune in interest and takes years longer to pay off. It's incredibly expensive debt.
So paying it off requires sacrifice.
Usually, yes. You need to get aggressive. He lays out 5 steps.
Okay, what are they?
1, stop adding to the debt. Put the cards away if you need to. 2, figure out exactly how much you owe, to whom, and at what interest rates. 3, try negotiating lower APRs, like we discussed. 4, consider balance transfers carefully, maybe, but focus on payoff. 5, create a payoff plan, find extra money in your budget, maybe using the conscious spending ideas, and throw it at the highest interest debt first.
He shares a story about Melissa Brown, someone who learned from mistakes.
Yeah, showing it's possible to turn things around with a plan.
So actionable steps for the listener here. Get your credit report and score, understand your cards, set up full auto pay if possible.
That's a great start.
Yeah.
Now, banks, another area for optimization.
He highlights the fees, especially overdraft fees.
The numbers are crazy, right? Billions of dollars banks make from overdrafts, charging $30 or $35 because you were short by, like, 50 cents? It's absurd.
And his point is, avoiding these fees is often a bigger win than chasing a slightly higher interest rate at a traditional bank.
Totally. Those fees add up way faster than a fraction of a percent in interest on a typical checking or savings balance.
Which leads him to recommend online banks.
Strongly. Back then, he mentioned ING Direct and Emigrant Direct, obviously. The landscape changes, but the principle holds. Online banks have lower overhead, no branches, so they can usually offer much higher interest rates on savings and lower fees.
Better customer service sometimes too, ironically.
Yeah, often focused on efficiency. He even told a story about ING basically being okay with losing high-maintenance customers to keep costs low for everyone else.
But you can still negotiate with traditional banks, right? He got an overdraft fee waived at Wells Fargo.
He did. The keys were being polite, persistent, and reminding them of his long customer history. Leverage your relationship if you have one.
And his friend got ATM fees waived just by asking.
Shows it's always worth asking.
So the action steps for banking.
Definitely open a high-yield online savings account. There are plenty of good options now with competitive rates and low or no fees. Maybe consider an online checking account too, like the Schwab one he mentioned, known for low fees and ATM fee rebates.
Okay, this feels like a good point to talk about the real powerhouse concept. Automation, the automatic money flow.
Yes. This is where it all comes together, setting up systems so your money goes where it needs to go without you manually moving it every month.
He quotes David Back, automation is key to becoming an automatic millionaire.
The goal is to spend maybe just a few hours a month actively managing money because the system handles the day-to-day.
So you link it back to the conscious spending plan categories, fixed costs, investments, savings goals, guilt-free spending.
And you automate transfers into those buckets. He uses Michelle's flow as an example. Paycheck hits checking, then automatically money zips off to her 401k, her Roth IRA, her savings account for a down payment, her travel fund.
How do you practically set that up?
Gather your account numbers. Set up direct deposit from your job. Then, use your bank's online bill pay to automate everything: credit card payments, paying the full statement balance, rent or mortgage, utilities, student loans, even transfers to your savings and investment accounts.
Set it and forget it, like Gina Trapani said.
Pretty much. You still need to check in, maybe use a tool like Mint or Quicken was back then, or similar apps now, to see the big picture, track goals, check net worth.
But a heavy lifting is done automatically.
Right. Oh, and a useful tip. Try to get your bills on the same schedule, maybe paying everything on the 1st or 15th. Call the companies, they can often adjust due dates, makes the automation simpler.
But still review your credit card bills, even with auto pay?
Oh, absolutely.
Yeah.
Auto pay the full balance, but glance at the statement each month to catch errors or fraud.
Okay, automation is set. Money is being saved. Now the big one, investing. making that money work for you.
This is where the real long-term wealth building happens. But it intimidates people?
He uses Anne Berg's story. She paid off debt with an inheritance, but realized that wasn't enough. She had to start investing.
Yeah, it's the crucial next step. The basic idea is simple. Buy assets that tend to grow over time. Let them compound for decades. Buy low, sell high is the mantra. But for most people, it's really buy consistently and hold.
But the problem is, many people just do nothing.
Right. Analysis paralysis, fear. He puts people in categories.
Mm.
As already investing well, C's, lost cause maybe, and B's. The biggest group could be persuaded. He's talking to B's, aiming to turn them into A's.
And he lays out systematic steps to start investing. Getting started is the main thing.
Exactly. Run one. Maximize your employer's 401k match.
Explain the match again. Why is it so important?
It's free money. If your company matches, say, 50% of your contributions up to 6% of your salary, you contribute 6%. And they add another 3%, instantly a 50% return on that part of your contribution. You have to get the full match if offered.
Even with worries about accessing it early.
He addresses that, yeah. There are penalties usually, but the bigger risk for most people is not saving it all. Call HR, find out the match, contribute enough to get it all. That's step one.
Okay. Rung 2. Pay off bad debt. We covered that. Rung 3.
Open a Roth IRA.
Why Roth?
Tax-free growth and tax-free withdrawals in retirement. Huge advantage. He says, aim to open one this week. Just get the account open at a brokerage firm. Vanguard, Fidelity, Schwab, others he mentions later.
Rung 4.
If you still have money after the 401k match, debt payoff, and Roth IRA contribution, then max out your 401k up to the annual limit. Remember, the company match doesn't count towards your contribution limit.
And Rung 5.
Only if you've maxed out all the tax-advantaged options, 401k, Roth IRA, then open a regular taxable brokerage account.
And the timeline matters. Short-term money and savings, long-term in investments.
Crucial distinction. Under 5 years, probably savings. Longer than that, investing makes sense. And set up automatic monthly contributions to that Roth IRA, even if it's just $50 or $100 to start. Build the habit.
Now, he really goes after the idea that you need some financial expert guru to manage your money.
He does. He points out that most active fund managers, the people trying to pick winning stocks and time the market, actually fail to beat simple market index funds over the long term, especially after you factor in their high fees.
Fees like expense ratios and loads.
Exactly. Expense ratios are the annual percentage fee the fund charges. Loads are sales commissions, either upfront or when you sell. They eat away at your returns significantly over decades.
So active versus passive management.
Active managers try to be clever, pick winners, charge a lot. Passive investing using index funds just aims to match the market's return, like the S&P 500, at a very low cost. And historically, passive wins most of the time for most investors.
The 85% solution, he calls it, meaning simple is good enough for most.
Yeah. Don't strive for perfection. A simple, automated plan with low-cost funds gets you most of the way there. Life cycle funds are a good example of this simple approach.
So automatic investing, what's the process?
It's basically 1. Decide your asset allocation. Mix of stocks, bonds, etc. 2. Choose your investments. Low-cost index funds or a life cycle fund. 3. Automate regular contributions.
And the benefits.
Takes emotion out of it. Avoids chasing hot stocks. Requires very little ongoing effort. He calls it Zen investing. It's boring, but it works. And it's recommended by people like Warren Buffett.
And the risk of not investing.
Losing purchasing power to inflation and missing out on potentially huge long-term growth. Compounding is magic, but it needs time.
So long-term perspective, diversification, and asset allocation is key.
Hugely key. How you divide your money between stocks and bonds drives most of your portfolio's risk and return, much more than which specific stocks you pick. He mentions studies proving this.
And for younger investors, say 20s or 30s.
General advice is often to lean heavily towards stocks or stock funds because you have decades for growth and to ride out downturns. The biggest danger isn't market crashes. It's not investing at all because you're overwhelmed.
Okay, let's dig into those fund types more. Life cycle funds first, also called target date funds.
Right. Super simple. You pick a fund with a year close to when you expect to retire, like Target Retirement 2050. A fund automatically handles the asset allocation for you.
How?
It starts aggressive, more stocks when you're young, and gradually gets more conservative, more bonds, as you approach the target date. It's completely hands-off.
The trade-off.
Might not be perfectly customized to your exact risk tolerance, but the convenience is huge. Great set-it-and-forget-it option. He mentions funds from T. Rowe Price, Vanguard, Schwab, Fidelity. Check their expense ratios and minimums.
Okay, versus index funds.
Index funds also have low costs, but you have to decide on the mix. You might buy, say, a U.S. stock index fund, an international stock index fund, and a bond index fund to build your own diversified portfolio.
Requires a bit more work.
A little more upfront to choose the funds in your allocation, and then you need to rebalance periodically, maybe once a year, to bring your percentages back in line if one asset class has grown much faster than another.
What if you don't have enough for the minimums on multiple index funds right away?
He says just start with one. Save up for the minimum for, say, a total U.S. stock market index fund. Get that going with automatic contributions. Then save up for the next one, maybe international stocks. Then bonds. It's not a race. Build it over time.
And once you have them, you just split your monthly investment across them based on your target allocation.
Exactly. If your target is 70% stocks, 30% bonds, and you invest $500 a month, $350 goes to your stock funds, $150 to your bond fund.
He shares that story about moving his own 401k money into an index fund during a downturn, quoting Buffett.
Be fearful when others are greedy, and greedy when others are fearful. It shows conviction in the long-term buy-the-dip approach rather than panic selling.
And the tax advantages of 401ks and Roth IRAs are a big part of the strategy.
Huge. Tax-deferred or tax-free gross is like turbocharging your investments. It strongly incentivizes holding for the long term. Outside of retirement accounts, you have capital gains tax when you sell, though long-term gains are usually taxed at lower rates.
When should you sell investments, according to the book?
Rarely, especially with index or life cycle funds. The main reasons would be a true emergency need for cash, an investment consistently underperforming its benchmark for years, or reaching a specific goal the money was saved for, like a house down payment if it was in a taxable account.
What about the student loan payoff versus investing debate?
It's often a close call mathematically, as interest rates might be similar to expected market returns, but the power of compounding early on and the tax advantages of retirement accounts often mean it makes sense to at least start investing while paying down the loans, maybe a hybrid approach. Don't wait until loans are gone to start investing if you can help it.
Okay, briefly touching on money and relationships. Parents.
Encourage self-sufficiency. Offer guidance and help them make a plan if they're struggling, but avoid just taking over or enabling bad habits. Communication is everything. Talk openly, understand each other's views on money, values, goals. Work as a team. He mentions the 28,000 question, how wedding costs tend to balloon, underscoring the need for early budgeting together.
And negotiating salary.
Mindset is key. Don't reveal your previous salary if you can avoid it. Focus on total compensation, salary, bonus, benefits. Be cooperative. Frame it as how you'll help the company succeed.
Finally, big purchases. Cars and homes. What's the main takeaway for cars?
The biggest financial factor is how long you keep it. Buy reliable, maintain it, aim for 10+ years. Choose one you actually like, research resale value, and negotiate hard. He even recommends specific resources for negotiation tactics.
And homes. He seems more cautious there.
Very cautious. Can you really afford it? He pushes for at least 10%, ideally 20% down. And make sure the total monthly cost, mortgage taxes, insurance, maintenance, PITI, plus upkeep, is comfortable. It's often way more than just the mortgage payment, maybe 40–50% higher than rent was.
Any rules of thumb?
Stick to basics. 20% down if possible, 30-year fixed-rate mortgage, total payment under 30% of your gross pay. And importantly, don't assume real estate prices only go up. They don't.
Wow. Okay. We have definitely covered a lot from I Will Teach You to Be Rich. Let's try and recap the absolute core takeaways.
I'd say focus on the big wins, not pennies. Automate your savings and investments. Invest consistently for the long term in low-cost, diversified funds, especially in tax-advantaged accounts like 401ks and Roth IRAs.
Optimize your credit cards, use them strategically, pay them off fully, avoid fees. Same with bank accounts, minimize fees, consider online banks for better rates.
And practice conscious spending. Spend lavishly on what you love, cut ruthlessly on what you don't.
Right. So a final thought for you, the learner, to chew on. Now that you've got this framework, what does being rich actually mean to you? It's probably more than just a dollar amount.
Yeah, how can you use this knowledge to build your rich life, whatever that looks like?
Yeah.
And maybe even help others. And maybe most importantly, what's one small thing, just one step you'll take today based on all this?
Great questions. Thanks for diving deep with us.